Well, back home now, and Westpac's latest economic overview paints a slightly more optimistic year ahead for New Zealand. The bank's economists predict just over 2% growth in 2025, and with mortgage rates declining, house prices are tipped to rise by 8% over the year. As Zane Small reports, figures show investors are now returning to the property market.
A brighter economic outlook is attracting property investors like Matt Ball back to the housing market.
Yeah, we started to have a wee look at the market, have a look at some properties that are for sale.
He's a typical mum and dad investor with one property, but rate cuts and policy changes are giving him the confidence to expand his portfolio.
One is that interest rates are on a downward track. The second is that interest deductibility is on its way back.
There's also the return of 90-day no-cause terminations for periodic tenancies, and the Brightline test is back to 2 years, meaning if you sell an investment property after 2 years, you don't have to pay tax on the profit. It all appears to be making property investment more attractive. CoreLogic data shows the share of properties purchased by mortgaged investors is rising.
The regulatory changes that have impacted investors for so many years, loosening, has again shifted that confidence and shifted that growth in the market.
Most importantly for investors is that rental yields are starting to improve. That's the difference between how much income a rental property makes compared to how much it costs. For example, a lower interest rate reduces the amount of cash a property owner has to top up to pay the mortgage.
Very many property investors have been subsidising their tenants, basically.
The fall in interest rates also affects property prices. Westpac's latest economic overview published today predicts prices to rise by 8% over 2025, and that will help to support an eventual recovery in construction activity.
There's a pretty strong relationship between interest rates and house prices in New Zealand, and we have actually seen a significant amount of easing occur in the last 4 or 5 months.
But to ease interest rates, the Reserve Bank had to be confident that inflation was going down. It has been because spending is down, and that's led to a rise in unemployment.
The unemployment rate is still in the process of adjusting up from the quite slow growth we've seen for a while, and we don't think it's going to peak until probably the middle or second half of next year.
So still some clouds hanging over the economy, but enough sun to bring some optimism to the property market.